Michael, thank you for that kind introduction and the opportunity to speak to you all today. As Michael said, I work for the index part of McGraw-Hill Financial, S&P Dow Jones. And indices are like rabbits. They produce and they multiply. We calculate more than 1 million indices, and it's pretty fair to say there is not capital against every single one of those. For instance, we used to calculate an Icelandic bank index. We don't think there are many components in that index just now. We are best known for the S&P 500, of course. It is a significant pool of capital. It's a way for investors to get exposure to cheap beta. There are $7 trillion of capital benchmarked to the index, of which around $2.5 trillion are passively tracked. In terms of the context of this, we also have the Dow Jones Brookfield Infrastructure Index, which is becoming a significantly important index both for us and for investors, to the extent there's now around 50 billion linked to that index. So we feel we have a little bit of perspective on the infrastructure story. But I was interested this morning because I don't get so much exposure to the fixed income side. It's much more on the equity side. So what I'd like to do in the next 20 minutes is first of all prove that presentations don't necessarily expand to fill the time available, number one. And number two is to get you thinking a little bit more about equity and passive investment from a pension fund standpoint. So as Michael alluded to, I'm actually focused on pension funds, so I'm not an infrastructure specialist, but over the last 2 years I've spoken to around 120 funds one-to-one across a variety of issues, and infrastructure is very much a part of that. And there's very real interest in the asset class and gaining exposure to those risk premia. So I'll just begin with a quote. I think it's always nice to do that Roger McNamee isn't a philosopher by any means. He's a sometime venture capitalist, musician and businessman. But he talks about economic stimulants shouldn't be done by infrastructure. This is all about making a path for long-term growth. Bridges to nowhere, he describes. And I was reminded of the BBC report quite recently where they talk in the US about 66,000 structurally inept bridges in the US. It's a phenomenal number. It's 1 in 9 bridges. So a more phenomenal number is there's 1 bridge for every 600 people in the US. And some of my US colleagues were blown away by that. But what it means is it's both an opportunity and a cost in terms of investors, and pension funds are grasping onto that. And then from another side of certainly the equity standpoint, ports, right? So ports fuel trade. In the US, 95% of import and exports go through US ports. Probably no surprise. But ports on average are 25% smaller than their global averages. So there's scope for more investment to oil growth and oil the economy in the US. Pension funds are grasping on to those opportunities. So the agenda today, over the next 20 minutes or so, I'll share with you how we think pension funds are looking at infrastructure, some of the issues they have, how the real impediments they have, cost, transparency, interact with the infrastructure asset class, and particularly in this cost-focused environment, do they feel they can get exposure to the risk premia in an effective way that fits with their governance? So I think the macro environment, most of you here will be very familiar with. I think there's 2 things that I'd like to really speak to. One is the spending gap, so the $1 trillion per annum spending gap identified by the World Economic Forum. And this is before the $700 billion or so that's predicted to be required in green growth. So, for instance, we know in 2030 that about 50% of the world's population will live in areas of high water stress, and you're already seeing that in California at the current time, where over the last months or 2 years you have a drought. So investment required there. Now, if I ally that to what's going on in pension funds, the global pension fund market is about $40 trillion in size, and it's growing. It's growing rapidly for obvious reasons. But less than 1% of those assets are invested in infrastructure. It's a bit of an uneven picture, however, because funds who are investing typically commit about 3% to the asset class, but they'd like to commit more. In many cases, they're looking for 5%. So what we're pointing out here is there's a spending gap and there's a target investment gap. And the challenge is to put this together, and pension funds are trying to meet this in whichever way they can. They're starting to do that through looking at listed. So I think the landscape itself is interesting. It's somewhat self-explanatory. I've borrowed this slide from Towers Watson and Clarendon. Pension funds often lump infrastructure in with real estate to a certain extent. They see similar characteristics. Of course, that isn't always the case. Gonzalo made a nice presentation earlier and alluded to regulatory risk, much higher in infrastructure than it is in real estate, and also the holding periods are much higher. So the I3 survey of 2013, which is the most up-to-date survey, says that around 55% of respondents are taking a 10 or 20-year view to infrastructure investments, even in equity and debt. I think we all know, I'll get it out in a second, unallocated capital is at record levels. It's up to about $100 billion. And so again, pension funds are saying, how on earth can we get exposure to these risk premia if the projects aren't there? In terms of the return expectations, I was talking to Michael about this earlier. I think equity can speak very interestingly to what investors are looking for. So if you think about core and core plus, 7 to 13% target returns over the life of holding the asset. Keep that number in mind in terms of what we're going to show you a little bit later. And in terms of the types of investment, core plus, you're seeing airports, ports, and rail assets. So the Dow Jones Industrial Average is actually one of the original infrastructure indices because it was originally a railroads index way back in 1880, and it's evolved over time to become what it is today. So in terms of what pension funds are dealing with right now, there's a significant increase in passive investment. PricewaterhouseCoopers talked a year or so ago about retirement assets doubling over the next 8 years. And of course, there are reasons for that, very obvious reasons. But within that, passive investment is going to double as well. So there's a fourfold increase in the opportunity for passive investment. And the reasons for that typically are the pension fund focus on cost and transparency. And I'll give you an example of that. The National Employers Savings Trust Fund, which is the auto-enrollment fund in the UK, has a target investment management cost of 9 basis points. 9 basis points. So if you think about how you access infrastructure cash flows, where intuitively the fees are much higher, pension funds are saying, well, how are we going to get access to that and how are we going to do that? So these are some of the issues they're dealing with. In terms of volatility and drawdown, obviously the crisis gave everybody a big shock. So short-term volatility funds are looking to manage, and you're seeing that through low volatility approaches to equity. And drawdown protection as well through diversification. So now you see pension funds in the UK sometimes up to 30% in alternatives compared to only 5% maybe 20 years ago. There's been a real shift towards these real assets. In terms of costs, there's a nice Preqin survey on infrastructure investing, and the respondents identified that 1 in 3 were most concerned with the fees they would be charged to get access to these risk premia, and 1 in 4 were concerned about transparency and asset values. So again, that interacts very closely with the key issues pension funds are having. And in terms of what investors are doing, why are they doing it? Well, again, the I3 survey said the most desirable attribute is inflation protection. Then income generation, and in some cases with a risk profile equal to low risk debt. So again, perhaps that's counterintuitive. You're looking for a 10 or 13% return with a standard deviation less than 5%. It's kind of tricky to find those risk premia. Typically, funds are very large in size. The average size is 6 billion. The European pension fund market is $7 trillion in size, and there are literally tens of thousands of funds. So outside of the top 350, funds are saying to us, goodness me, there's a good story here. How can we get access to it if we're a smaller fund? And again, just to frame the background, if you haven't read this survey, it's the Mercer survey on asset allocation. It's an extremely good thing done annually. It's 1,500 funds. On the left-hand side, what this speaks to is fund expectation for active management. So when they're instructing an active manager, irrespective of the size that they are, they're looking for around 250 or 300 basis points of excess return over the benchmark. Now, in the equity space, you can get that just by going equal weighted. It's quite powerful, and you're not paying the fees to do that. Now, we've done that research. But this is one of the phenomena that's driving investors more into passive. And again, it's one of the issues for infrastructure investors to say, how are we going to do this if we have a typically passive approach from the investment standpoint? And then on the right-hand side, you see, with respect to all sizes of fund, except the very large ones, 40 or 50% of assets are already allocated to passive. So, again, you've got that disconnect. We want exposure to the risk premium and the cash flows, but we're necessarily passive in our approach. How are we going to do this? Unfortunately, it's more bad news for active managers, and I'm not bashing active managers for those of you who are here. I'm a pension fund beneficiary. When I retire at 67, or heaven forbid 72 or 75 when I eventually get there, what I want is the biggest possible pot, the biggest possible return. And if you're good at picking an active manager, and better still, you can empower that manager to take risk, and you can hold him accountable with a suitable benchmark, you should go ahead and do that. If you're not good at that, then clearly you need to start looking at passive. So this is a resource that we have, and as I say, it's not great news in the equity space. So in the US on the left-hand side, and I ask our marketing people to spin this around so it doesn't look like we're bashing passive so much, active so much. So 14% of managers beat the benchmark over 1 year, or 80%, 86% don't. In Europe, it's slightly better. An absolute example of that is in the US. In March 2013, there were 700 managers in the top quartile for large cap and mid cap equity. 2 years later, there were 40 managers still there. And if you take that back 5 years, there wasn't a single manager in the top quartile. So again, to be clear, not bashing active, but these are the issues that pension funds are looking at and saying, this is perhaps why we're looking to go passive. So this top quote was taken from the CFA Institute paper on infrastructure benchmarking. And I think it's a nice analogy. If you invest in a farm, you don't really know what your return's going to be until you get the harvest. And I think obviously that is the case with many cases of greenfield, brownfield infrastructure. And I quite like the Margaret Thatcher quote. There are many, but I quite like this one. So I'm very patient as long as I get my own way. And investors are looking at that and saying, well, perhaps we won't get the returns we seek at the end of the 7, 10 or 20-year horizon. And when we don't have the opportunity to sell in the meantime. So, again, it's framing why pension funds are doing what they're doing. So in terms of listed infrastructure, which is where we have a little bit of expertise, we partner with Brookfield, a specialist investment manager in the space, as of course you'll know. The market has scale. So there's in excess of $4 trillion in market cap, about 3.3, 3.5 trillion in equity. So there is scale to get some capital deployed, particularly in the case of where you might be looking for unlisted projects to make themselves available. The debt market is around 700, 800 billion. Unfortunately, there's a lot of investors chasing that right now. I think right now there are 150 funds raising about $100 billion for infrastructure debt. Clearly that's going to drive yields down. So again, this is a consideration pension funds have in terms of our discussion. And I think what listed does is it gives really pension funds what we call a governance advantage. So obviously listed markets have better demands of regulatory bodies and reporting requirements, and that gives them comfort, particularly in the small and mid end of the market. And again, that's why listed securities are really starting to hit their radar screens. And some big examples, AP4, the big buffer fund in Sweden, has allocated about 9% to its equity bucket. New Zealand Super has allocated 6% in equity, but to its infrastructure bucket. I won't spend too much time talking about this. This is taken from the CFA Institute. I think there are two takeaways from this, two distinct problems, and they're both at the top. So the CIO level problem and the infrastructure team problem. So for the CIO, it's about how to assess whether unlisted infrastructure investments are attractive relative to other opportunities in the marketplace. And secondly, can you deploy capital while you're waiting for those opportunities to reveal themselves? And perhaps the bigger thing is just assessing the manager value add using an appropriate or semi-appropriate benchmark. So it's very difficult, for instance, to really advocate using a listed benchmark for unlisted because you're comparing apples with automobiles, but there is an opportunity cost there. What if I went passive in the equity space and paid much lower fees than compared to 1.5% or 2% plus a performance fee from an unlisted manager. So again, these are issues that funds are grappling with. In practice, we see very much a hybrid approach, or even a hodgepodge approach, you might say. So you get a mix of absolute return. 8% seems to be about the level that practitioners tend to settle upon. And then you get the CPI plus, or the hybrid approach. I think that the hodgepodge is really because infrastructure investment is done for different reasons: a substitute for real assets, an inflation hedge, sometimes a substitute for absolute return. And 40% of funds do not have a unique infrastructure allocation. So this is why you see this very different approach. And I think the CFA really advocates that you might take this approach along with a second tier, which is to take the opportunity cost benchmark. So I'll whiz through the back end of the presentation quickly as I can. It seems counterintuitive that equity could give you some inflation hedging, I think. But actually we find some very interesting characteristics. So on the left-hand side here, you see a basket of listed infrastructure characterized by Dodgems Brookfield, and on the right-hand side you see global broad equity. Times of benign inflation, this is 03 to 2014 US CPI, you don't get much performance differential. But in high inflation, you get almost a 50 basis point annual excess return. So, again, I'm not making a big pitch for equity as an inflation hedge, but there are very observable characteristics that we see through our index. From a growth standpoint, it's also interesting. I said at the start, keep in mind that 7 to 13% core return that you're looking for. So the square box is global infrastructure securities, and the return characteristics are quite nice. Of course, there's risk there, much higher risk than you would get from unlisted. But again, this is what pension funds are seeing and saying, okay, let's take a closer look at this. What is this doing for us? Now, I alluded to a number of respondents that wanted those kinds of returns, but with much lower risk profile, much lower standard deviation, as characterized by global bonds. And I'll touch on that right at the end of the presentation. Again, I don't think anybody would argue that equity is going to give you great drawdown protection. Nonetheless, if you look at this slide and you look around the financial crisis, so the 6 months after the financial crisis, the annualized 3-year returns of the Dodgems Brookfield minus MSCI World is somewhere between 7 and 9% annualized. So you still got drawdown. The max drawdown over that period was about 45%, but in equity it was 55%. So there is an element of drawdown protection. Now, once again, I'm not making a big case for it. There are other ways to do drawdown protection, but these are the unintended consequences of allocating capital in this way. I'll skip through that one quickly. This is a sector breakdown of the Dodgems Brookfield Index. It's about 130 companies. As you can see, it's pretty heavy on oil, gas storage and transportation. And you can see airports are a little bit fewer and further between. So in terms of diversification, you see there are very different characteristics of the underlying subsectors. And of course, you need to be aware of that as an investor in terms of what sort of attribution that's going to give you if you are a passive investor. Unless you have telescopes, you're probably going to struggle to see some of the numbers on here. So I'll leave you to peruse at your leisure. But I think there are one or two things worth pointing out here. For instance, electricity transmission is much lower correlated against global equity at about 60.6. For instance, in airports, which is about 0.85. And also, you should be aware that some of these sectors, there are very few components. So you're actually getting stock-specific volatility as opposed to sector volatility. So it's just something to be aware of. And then just to close out real quick, so we talked about those investors with a smaller risk appetite. This is an index we produced some weeks ago. Quite nice risk-return characteristics for global corporate bond with an infrastructure tilt. So about 200 issuers and about 900 bonds. And I think if you buy and hold over the life cycle that most investors say they're looking for, you get some quite interesting results. And this is something which has really caught on very quickly with some pension funds in terms of using it as a benchmark or even a passive underlying. So we're pretty excited about this particular index. So that's pretty much it from me. I think summary and conclusion is pension funds in particular are catching on that the core return expectations from unlisted may be available elsewhere, albeit at higher risk. But some of the characteristics they're looking for, inflation hedge, growth, definitely reside in the liquid market. And you have that daily liquidity. You can sell when you want to do as opposed to when you're forced to do or can't sell. Obviously, short-term correlation will persist. What we're really looking for, if there's anybody in the audience that knows a great database for unlisted infrastructure securities, we would love to talk to you, as we'd really like to be able to come up with a meaningful benchmark in that area for investors who may be looking at that particular asset class. And then the final takeaway, I think, is that there may be merit in a two-tier benchmarking approach. So, rather than saying to the manager, we can't have a benchmark because we're doing something very specific, you have that opportunity cost benchmark of not being passive and doing that very cheaply. So I'll leave you with a few words from our lawyers, which I'm not going to read out. There's a few. And so thank you very much for listening, and appreciate the opportunity. If there are any questions, be happy to take them. I can't hear you, sorry.
I was just saying it's the post-lunch syndrome, no questions.
Yes, it is. I thought the lemon syllabub was delicious. Hands up who had that. Thank you.